Okay, in this video, we're going to talk about net present value. And this is a concept in finance, right? When we talk about time value of money, and net present value is the first topic there. Okay, so when company invest in new product or new service, and they're hoping this kind of investment will generate a cash flow in the future. And this cash flow is typically multi-year cash flow, right? So when we make a decision, we always have some kind of expectation for return. And we want to see that if the future value, that future cash flow generated, gonna make sense, right? Which means that this is it's higher than our expected return. And so, net present value essentially is to kind of a tool for us to evaluate that kind of a situation. So, and there's tons of material online you can search up and read about net present value. And there's a particular website I like, and I posted the link here. You can take a look, read about all those concepts related to net present value and a formula. And then there's a couple examples there. I also posted the formula here. But now we're going to look at the example and see how can we kind of use net present value to evaluate a situation. So imagine your upfront design and launch cost for a sunglass business, right, is $90,000, and you expect to sell 2,500 pairs of a sunglass the first year and 5,000 pairs each year for the following 4 years. Your sales price will be $99 per pair, and your cost will be $88 per pair. At the end of the 5 years, you hope to sell your business, the Wildcat sunglass business, for $100,000. So what's your required return? What's your net present value? What's if your required return is 15%? Okay, so if you're expecting have a 15% of kind of return, and you can generate this string of a cash flow in the next 5 years, and what is the net present value here? Now, according to the net present value, we'll first discount those cash value to the present value, right, which is the year zero right now. And then we can add all those cash flows together. That essentially becomes our net cash flow. So for the first year, we are expecting you sell 2,500 pairs, and then for the price of $99 per pair and a cost of $88 per pair, your profit is $27,500. And if you discount it, was essentially $27,500 divided by 1 plus the 15% to the power of 1, because this is the time period, right? So this is the present value, which is essentially this value if you are looking at the current year. And then you can do the same thing for the second year. Basically change the year, instead of using 1, you're using 2, right? And then this is the third year and fourth year and fifth year. And then last end of life cash flow is also happen in the 5th year. So we discounted the 5th year. And then this is, you have also initial outlay of cash output, right? Because it's essentially for the launch cost, right? So the net present value, if you sum all these present value together minus the initial outlay, and this is your net present value. So for 90,000 initial investment, and if you expect a 15% of a return, this investment is worth $120,173. Okay, so this is the basic calculation, and this process is a tedious, right? And I went through a detailed calculation there. Excel actually has a function called NPV. Okay, because the last year, the fifth year, we have a 2 cash flow, and I combine that here. Okay, so I have the combined last year cash flow in this stream, and I can use NPV's function. So basically, you take NPV equal to NPV function, and B13 is the expected return or interest rate, right? And then take this cash flow and minus the initial capital outlay, okay? And then that give you the same answer. So that's about it. It's a very simple calculation of a time value of money and a net present value, okay?